Hey everybody, I'm here with Keith Weinhold. Welcome back.
Hey, it's so good to be here. It's interesting. I was last here in January of 2021. And remember, Ken, that's when we talked about how you can profit from inflation. Inflation was only 1.5% back then. So for all the viewers and listeners, had they watched that, they really would have profited from that surge of inflation.
We should go back and check that one out again, because I remember that discussion was fabulous. And now that's kind of the hot topic for sure. And so let's talk about, like, you're in Alaska and you've done a very successful job of going out of state, out of the network and buying real estate. How have you done that? Because a lot of people are freaking out around, how do I stay local? Do I go out of state? And there's a lot of things to consider.
I don't invest in my own local market. In fact, Ken, I sold my last local, meaning local to Anchorage, Alaska. I sold my last local apartment building last year. It's the first time in 20 years since I bought that first fourplex building. I don't own any local properties. I do all my investing out of state in investor advantage markets in the Midwest and South. And I know to some people it's scary to go out of state for the first time. For some reason with stocks, people feel quite comfortable with buying stock for a company. They don't even know where that company's headquartered. But with real estate and something called turnkey real estate investing, that's one way to go across state lines. But really, here's my mindset in getting comfortable with out-of-state investing. This is how I think of it, Ken. The property is only the fourth most important thing in real estate investing. And if you're thinking about investing, you often start by thinking about, okay, well, what would my next property be? It's important, but there are three things more important. Number one is you. What do you want real estate to do for you? This is what I like to share with people, Ken. Secondly is, what market are you in? Thirdly, what's the team of professionals, especially your property manager, that you choose to surround yourself with? And then fourthly, and only fourthly, is the property. So let's go through that. It starts with you. What do you want real estate to do for you? Are you looking for cash flow, which is common, or appreciation, or tax advantages, or a lifestyle benefit, like maybe you want to live in it yourself? Once you've got that figured out, what you want real estate to do for you, the market is the next most important thing. There is more risk with being in a little hodunk market of 6,000 people where half the employment is tied to the zinc mine than you think. So I like to be in larger metros where you have a diversification of economic sectors, something that you really excel in, Ken. So the market's that second thing, because you need to have a place that's going to be filled with tenants. And when you buy your property, you need to have a reasonable expectation that 18 months down the road, you're going to have another tenant that's going to be able to come in and fill that property. And then the third most important thing is the manager, your team. I mean, a bad property manager would drive a good property into the ground, because you want this to be relatively passive. And fourthly, and only fourthly, is that property. And you know what happens, Ken? I see this happen so often. People get it 100% backwards. They go 4, 3, 2, 1. First, they get all excited about a property and buy it because it has pretty blue shutters. Then they try to figure out if there's a good manager in the market, because they don't like to get texts from tenants. And then secondly, they try to figure out the market that they bought in, and it's too late. And then they go back to number one, which is you, which you're just so far out of line in. This is why a lot of people say that real estate doesn't work. So again, the property is only the fourth most important thing. It starts with you, market, and team first.
Yeah, I find that if they're lucky, they do go 4, 3, 2, 1 all the time.
Right.
It drives me nuts because, as you know, and most professionals go 1, 2, 3, 4. And I think what happens is, if when they get to 1, they're figuring it out, you need to start there, because it certainly clears up the vision, right?
Yeah, 100%. And you intrinsically know this, but you just haven't thought it through before. Like, for example, you already know that the market is more important than the property. A giant mansion in a swamp outside Charleston, West Virginia is not worth much, but yet a tiny 400 square foot efficiency apartment in the Tribeca neighborhood of Manhattan can be worth an awful lot. It just reinforces the fact that the market's more important than the property, and a lot of people get it wrong.
It always has been, and it always will be, because you can screw up a purchase in a market that's going like this, and you'll still look like a star.
Yeah, and this will be true a decade and maybe even a century from now.
Yeah, so that's why the market's so important. So let's talk about the most controversial thing here, which is why there's 100% certainty, 100% of a housing crash. This is I heard you talk about this, and we talked a little bit about it for the podcast. I said, let's just wait. Let's talk about it on the podcast.
there is a 100% certainty of a housing crash. And one might be wondering, first of all, how could you say that? No one has complete clairvoyance to know the future. And the reason there's a 100% certainty of a housing crash in this era is because it already occurred. It happened in April of 2020, more than 3 years ago. It was a housing supply crash, not a price crash. And in fact, the fact that we have had a supply crash really hedges against any sort of price crash. So using Freddie Mac data, and I shared the chart with you before I came over to the studio here so that you could see the backup. There are so many ways to go ahead and measure the available supply of homes, but about 1.5 million is what you'll see Fred, the Federal Reserve real estate data, or rather Federal Reserve economic data. About 1.5 million has historically been the amount of available homes going back to 2016. It began to fall after that. With what happened in the health crisis, it plummeted in April of 2020 to 600,000 units, and it still hasn't rebounded, and it's continued to fall. So it's a 60% supply crash, 1.5 million down to less than 600,000 now. And that's what hedges against a price crash. That's why prices are continuing to stay buoyant. At whatever demand level, the supply is really low, and that helps keep a bid on property. And really, I'd like to share with you the profundity of the fact that we've had a supply crash, not a price crash. I mean, think about this. We're the most powerful nation in the world by so many measures. We're the most powerful nation as far as political positioning, and our military, and our currency, and our brand. The most powerful nation in the world, and we have trouble housing our own people. I mean, we're talking about food, shelter, safety, Maslow's hierarchy of needs, base level stuff here. So it's actually a bigger deal than a price crash. If you think about it, you may very well see more homeless people in your hometown, for example. So the crash already occurred, a supply crash, not a price crash.
Yeah, it's an important distinction. And I think people really need to back up from this a little bit and understand where things are headed. You know, we have affordability problems. We definitely have homelessness issues creeping up. And so what really challenged everybody were these federal funds increases and interest rates that went up. So all of a sudden, you know, we've also had the largest delta between rents and the average mortgage price. So you got mortgages here. So rents and mortgages were kind of trending along at a pretty equal amount. But now, because of the home prices that went up and the interest rates went up, there's a big gap between rents, even though rents have gone up. So that's also keeping people in their houses because they've got the 6%, let's say 5-6% interest rates, but they bought them at 3%. So they have this trapped equity, right? So if you own a home that's $500,000 and you have 3% on it, you're not going to move, right?
No, it's the mortgage interest rate lock-in effect.
Yeah.
And that's a really astute point, Ken, because this plays in to the national dearth of supply. I talked about 1.5 million available units down to 600,000. I talked to just lay people and everyday homeowners that have become landlords because they say, I don't want to sell my home at its 3.25% interest rate. So when I move out of it, I just want to hold on to that loan and rent it out. In the United States, you can't move your mortgage along with your property like that. So it's that interest rate lock-in effect. That property, rather than coming up for sale, which would increase supply, doesn't. It stays put